Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show. So we're going to look at three different things. We want to look at, obviously, what the report showed, which was a bit bearish, but we want to look at, there is some upside coming for next week, and we want to look at why. Then again, as in the second segment, we've been talking about how demand was going to disappoint. It continues to disappoint. We don't see that pivoting. We will see demand go up. We're not saying demand isn't going to go up. We're just saying it's not going to go to the levels I think the market is anticipating. And then we want to look at, in the third segment, the physical market and the Chinese demand area, and why we think Chinese demand is really going to fall flat versus, or I should say fall flat going forward versus what the expectations are in the market. So with that being said, please like, share, subscribe. We need some support. My Bloomberg is running out, and I need a way to pay for it. So as you'll see, this segment is very, very much Bloomberg heavy. So obviously your support is appreciated. So with that being said, we're back to these great slides that is put together by BNEF. Total oil and product stocks, the surplus narrowed from 65.9 to 59.2. You can see that this goes back to 2017. So we don't have some of the bigger, like 2016 was a much bigger year because of the OPEC price war. So that isn't in here. So it would look a little bit better, but it just gives you an idea that there's a decent amount of crude and products sitting in the market over the average. Total crude stocks, land and floating, surplus widened from 66.6 to 69.1. So again, you're seeing that go up. And then the total oil product stockpiles, the deficit widened from negative 0.8 to 9.8. So yeah, when you look at the product side, it's fairly balanced. Gasoline is very much saturated. Gas oil distillate is not, which is, again, that bifurcation that we've seen that's going to continue. But when you look at land and floating on a crude side, there is a decent amount of crude out there. It doesn't mean it's the right crude, and that's the differentiating factor that we talk about between heavy and light and some of the different pieces. And when you look at land and floating, one of the things that we talked about is that we saw things going sideways, and typically we should be having draws. Like, we should be drawing on the crude front right now. And you can see that we're just kind of going sideways. Now, in the US, we did have a small draw, which isn't reflected here, but we did have a sizable build in Europe, which would offset this week's draw. So that's why it's very much a balancing act. You look at Europe, they've started to shave some of their utilization rates. You're not seeing the same level of demand. We've had some hiccups just today in the US, which we'll talk about in a minute. And then when you look at Russia, diesel and gas oil shipments have slowed in recent days after nearing the record levels that we talked about last week. Flows of the fuel are now at about 1.16 million barrels a day versus 1.17. Still, volumes are more than 20% higher than a year ago. And a lot of these cargoes are heading to South America. So it's going to be a matter of how much of this essentially competes, or at least takes away some of the downside when you look at the U.S. based on where our exports are going. On the straight crude side, we flipped to a surplus. We went from down 3.2 to up 6.6. So this is looking at land. We've started to see some of this coming through. West of Suez, the surplus widened from 0.6 to 3.7. And then east of Suez, it flipped to surplus from minus 3.8 to positive 2.8. Now, one of the things that we talked about when you look at this is, one of the things that we've been saying is that we're not going to have draws. We're just going to go sideways. We'll have draws. It's just we're going to have builds, draws, and we're going to have this fairly flattish level. And you could see that there's usually pretty consistent draws from this point on out. And we just don't see that, which is why we've been saying that on the west of Suez side and east of Suez, when you factor in China, that we're going to see these levels stay elevated and the comps get a bit easier, which means that we will go above that seasonal average. And that's where we start to see some of the pinning of the crude side. Now, we are not sitting here saying that crude prices are going to collapse. They're not. The supply isn't there, but demand isn't there either. And that's where you get this kind of back and forth, and why we do see some pricing here kind of topping out with a bit of downside coming. Total floating storage surplus narrowed from 46.6 to 39.9. We're blowing through the averages right here. This is 2015 was higher. But again, you get an idea of floating storage levels. West of Suez, surplus wider from 6.5, to slightly above 6.5. But you can see that we're setting a new seasonal record. As east of Suez, the surplus narrowed from 36 to 31.7, but is still setting a new record driven based on the mixture of Asia and the Middle East. So again, there's a lot of crude on the water. It's still waiting to get absorbed, which is why we see some of that land side in terms of that balancing act. We have some of these refiners in some areas slowing down. There's support for additional activity in Asia, which we thought was going to see some slowing. So again, you're seeing some of those different pieces. Now, before we get into the EIA data, we wanted to address the supply oil adjustment. For those that have been following us, I have to be very clear. We've been saying from the beginning that as our exports increase, you're going to see a very large crude supply adjustment. Because remember, the filings, especially when you look at exports and imports, the filings don't have to match up with the actual physical flows, and those are only adjusted on a monthly basis. There is always a true up. There's always a back and forth. It will clear itself. It's just a matter of where is this going to get moved into the system. We have had some additional blending, especially when you look at how weak naphtha prices have been, and the U.S. produces a lot of condensate. So there's a lot of things that come into this. It's not them manipulating. It's all of this is an algorithm, and there's some of the data is weekly and some of it is monthly. So it takes time for the catch up. And that's why we do see some of the report getting a bit more bullish next week as you get some of these adjustments filtering through the system. We're coming to the end of the month, which means that as we get into next month, we'll start to have some of these data points coming in. Again, this is not malicious. This is just the way models operate. I just want to highlight that before everyone kind of jumps around and how terrible this is and how Biden's using this. No, it's just like this has always been the case. And when we say always, my biggest comment when we started exporting crude, when I turned to my boss at the time and said, "Wow, this is really going to throw off the supply adjustment." And he's like, "Well, how come?" And I explained why. He's like, "Oh yeah, that makes sense." And here we are. So again, please, this is not manipulation or some egregious thing. Crude stocks had a small draw, came down 600,000 barrels. You can see we're above the average, 6 million above the average, fairly in line. Pad 1 had a small build. Pad 2 had some, and Cushing had some sizable draws, which we want to talk about. Pad 3, a build of 2.5. That's 15 million above the 5-year average. That's likely where we'll see the biggest adjustment, as that adjustment comes through, because we did get some sizable exports. Imports slowed down. So we should see a pretty big draw in Pad 3 as we go over the next week or two. Pad 5, small build, but again, fairly in line with where things are. And then because the SPR is done, that's why, we'll see that just match up. If anything, we'll see the SPRs have some small builds as we head through the rest of the summer. Crude oil inventories, excluding SPR, as you can see, flat lines. Like what we've been saying is we just expect this to go sideways. It won't get up to where we were in 17 and 2020, but it's just we have a comfortable amount of crude in the system. It doesn't mean it's the right crude, which is again what we keep talking about. Now we did have a hiccup at Exxon with coal. Which one was this? Cold Lake. When you look at some of the issues at Exxon's Baton Rouge refinery in Louisiana. So we did get some curtailment on the Canadian heavy side. So that did bring some of those spreads down. But by the spreads coming down, that will actually help additional imports into, especially on the heavy crude side, coming into Pad 2, because a lot of this was flowing down into Pad 3 by rail. So, and then rail volumes have come down. So again, there's just kind of that pivot. U.S. commercial oil storage and products, as you can see here, fairly sideways, as we've been saying, which is going to be, not much movement up or down. It's going to be something that'll be fairly stable. given the imports and export backdrop. Pad 3, when you look at Pad 3, you can see that we're well above average. The only time we were higher was 2020. So that's why, even though we're going to get a big adjustment just based on the crude adjustment side, with a lot of that being in Pad 3, it's just going to put us back to 2017 levels, and 2016 levels, which is still very elevated. So again, like, we're not seeing this massive bearish, this massive bullish backdrop, but we're not seeing a huge bearish one either, which is why we do see us very much range bound, not too much movement in one specific direction, which is going to keep things moving forward. Storage at Cushing, we thought as for those that have been watching us, we thought there was going to be a draw. We thought it was going to be in line with the draws from 2021 in terms of rate of change. We still see draws. It's just the rate of change is going to soften, and a lot of that is going to be based on, we had a big spike in exports. We'll see some of that drop back down. Again, not like a huge drop down, just in terms of just general flows and movements, as we do see some additional capacity coming down from the oil sands. When we look at runs, runs were down 90 basis points, so from 94.3 to 93.4. A lot of that was in Pad 3. You can see it had a drop of 171,000 barrels a day. A lot of that is just driven based on some issues and unplanned downtime and some hiccups. We did have some additional, so again, we don't see this having this huge uptime. It's going to be a matter as to how quickly. Is it something that is going to be, a 5-10 day downtime? Was it just a bad batch and they'll bring it back online? Was there a power surge which resulted, so things have been fixed and now they can bring things back online? Realistically, we're going to stay between that 93.5, 94.5. We don't see too much of an adjustment here. Bayway's back, which is why Pad 1 had a bit of a bounce. That's something that is going to continue to remain in Pad 1. When you look at refinery utilization rates, very much in line. You typically have a little bit of a drop, and then we'll have a bit of an increase. As we said, the heat was a big impact. That is going to remain for at least into the end of August, at the end of July, which again will keep things a bit slower. You also had some of the hiccups, so we'll stay kind of in this range with some of that upside coming. Then when we look at imports, as we were saying, imports were down 808,000 barrels a day. You can see Pad 1 had a small increase, and that's a lot of it because Bayway's back. You have some of that activity, so you need to make sure you can fill those coffers. Pad 2 was down 385,000 barrels a day. That brings us below the 5-year. We will see that bounce. Pad 3 would drop 514,000 barrels. We do see that coming up a bit, not taking back all that 514,000 drop, but again, taking back about 250,000 of it just based on what we're seeing in the water. And then Pad 5 remaining lumpy. So again, we'll see some of that come back through, but we won't see a huge surge in the near term. This just looking at Pad 3, as we were saying, it was going to drop. It was going to stay elevated, and we just see it staying at the bottom of that cloud, and coming back to what we were saying, where you typically have that decline in imports. We see things moving along those lines, just moving a bit closer to the 5-year average, but not obviously surpassing it. Pad 2 had the drop, again, seasonal. Some of this will bounce back. It'll stay above the 5-year average, not setting new highs, just, again, living in the top of that cloud. Now, implied demand, we expect to see gasoline get to about 9.2, 9.3 million barrels a day. Here you can see it was a bit softer. It only bounced to about 8.9, so an increase of 84,000 barrels a day. That's 383,000 below the 5-year average. So we do get some additional upside. Distillate, small increase of 49,000 barrels, as we were saying, kind of living in this realm. Jet fuel had a nice makeup. It's been a little bit lower because remember we were saying 1.5 to 1.65. It spent a decent amount of days at right around 1.55, so there had to be that makeup, and here it is. Propane, propylene, again, not huge demand. Chem's not active, all that active. So you can see it dropped 82,000 barrels. So realistically, jet will drop. Gasoline will continue to grind higher. Disti will kind of go sideways. So We'll still get a little bit of those increases, but not a huge amount. So we'll really kind of stay around that 14.8 million barrel a day when looking at those fuels. U.S. gasoline, you can see we expected to get back to that 10-year average, which is that darker blue line. You can see that right now we just went sideways. It will start to go up, but again, it's not going at a very rapid clip. And one of the things that is going to hurt a bit more, we are starting to see gasoline prices creep higher. That is not a good thing when you look at the pain that some of the people are under when you're looking at retail sales and some of those other key pieces, which is going to be a problem, which is why we still see gasoline underperforming. Days of supply, again, not too much to talk about here. It's very normal. Gasoline is tracking the 29-year average very closely. We have yet to see the meaningful amount of gasoline come from Europe. It's coming. It is here. Like we're importing at or above those averages. But we haven't seen a big unlock. When you look at Europe is over 14 million barrels, I think, at this point in terms of gasoline. So they're still well above 2020 levels, seasonally adjusted all-time high for gasoline. It's just ships are expensive, and they are just sitting there. European demand is dropping like a rock, and yet we haven't seen it too much come our direction. So again, that is keeping us fairly sticky. We thought we were going to move closer to 2020, 2022, that green line, but so far we haven't seen any real meaningful increase. Distillate, not a big, we had a small draw. It wasn't counter seasonal. When you look at some of the path, we need to start to see that really kind of close this gap. There's typical periods throughout the summer where you go flat or slightly down, but this is a bigger issue. Not so much in it, but not holistically speaking. When you look at, all of the U.S., because there are parts of the U.S. that are fine. It's really Pad 1. Pad 1 is, if we have a cold winter, New England is in a significant amount of trouble. As we were saying, jet bouncing around, we're right back to the 29-year average. Not too much to say there. The crude futures, as you can see, the curve is shifted up. We've moved higher when you look at, still staying in backwardation. Where we're seeing some of this shift up in the total curve. For those that have been following us, we think that makes sense at the longer dated crude contracts. It's not so much on the front end. Again, not that we're going to see WTI collapse to 70. We do think that at 79 and change, that WTI is a bit rich. And then when you look at floating storage, staying towards the lower end, we do have some additional cargoes coming in from West Africa, but nothing sizable. So again, we're going to stay at the low end, and that's why we don't see a huge surge in imports. Just kind of this balancing act, as we've been talking about, maintaining the course. So that's what we have for you here in the next segment, where you have the demand side, especially in the focusing on obviously the U.S. And we'll give you some color on where we think summer is going to close out.